Direct taxes have become a major source of revenue for the government in recent years. In FY 2023-24, they made up about 56.7% of India's total tax collection, meaning more than half of all taxes came from income tax and corporate tax. This share has been rising steadily, showing better tax compliance and a stronger economy. The article below shares details about the direct tax, its types, and its impact on Indian economy. What is direct tax? Direct tax is a tax levied directly on an individual's or entity's income, wealth, or profits and is paid straight to the government. The defining feature of direct taxes is that the burden cannot be transferred to another person. Examples include income tax, corporate tax, capital gains tax, and securities transaction tax. Historical background of direct taxation in India. Direct taxation in India has developed over centuries, evolving from simple agrarian levies in ancient times to a modern income and wealth-based system. Ancient period, taxes were mostly on land, agriculture, and trade. Systems under the Maurya and Gupta empires included organized revenue collection, with officials overseeing land and produce taxes. Medieval period, regional kingdoms and empires like the Mughals maintained structured land revenue systems, such as Zabt and Mansabdari, forming the basis for systematic tax administration. British era, the Income Tax Act of 1860 was introduced after the 1857 revolt to finance administrative and defense expenses. Direct taxation expanded gradually to include salaries, profits, and trade activities. Post-independence, 1947 to 1961, India inherited the colonial tax framework. Multiple amendments aimed to broaden the tax base and standardize procedures. Income Tax Act, 1961, consolidated various direct tax laws, created clear rules for individuals, HUFs, and companies, and introduced progressive taxation to promote equity. Recent developments, implementation of digitalization, e-filing, faceless assessments, and technology-driven monitoring improved efficiency, reduced corruption, and increased compliance. Direct taxes features. Direct taxes are a critical component of India's fiscal system, designed to generate revenue while promoting equity and economic stability. The features of direct taxes in India are given below. Direct payment to government. Tax is remitted directly by the taxpayer to the government without intermediaries. Non-transferable burden. The liability cannot be shifted to another person, the taxpayer alone bears it. Based on income, wealth, or profit, levied according to the taxpayer's ability to pay, ensuring fairness in taxation. Progressive nature. Higher income earners pay proportionately higher taxes, reducing income inequality. Legal obligation. Compliance is mandatory under law, with penalties for evasion or non-payment. Revenue source for government, funds public services, infrastructure, and social welfare schemes. Redistributive function, helps in narrowing the gap between rich and poor through progressive taxation. Indicator of economic health. Direct tax collection trends reflect economic growth, formalization, and financial transparency. Influence on economic behavior. Tax incentives encourage investment, savings, and adherence to formal financial practices. Also read, Goods and Services Tax. Types of direct taxes. 1. Income tax. Levied on the income of individuals, Hindu undivided families, HUFs, and other non-corporate entities. Follows a progressive structure, meaning higher income pays higher tax. Provides exemptions and deductions to encourage savings and investment. 2. Capital gains tax. Capital gains tax is levied on profits earned from the sale of capital assets, including property, stocks, bonds, and other investments. Capital assets include land, buildings, house property, vehicles, machinery, patents, trademarks, leasehold rights, and jewelry. Assets not considered capital assets, stock in trade, consumables/raw materials, personal effects, except jewelry and artwork, and agricultural land beyond specified limits. Types of capital assets. Short-term capital assets, held for 36 months or less, taxed at higher rates. Long-term capital assets, held for more than 36 months, taxed at concessional rates. 3. Corporation tax. It is a tax levied on the profits earned by companies, including both domestic and foreign firms operating in India. The tax rates differ based on the type of company, turnover, and whether it opts for concessional tax regimes. It is governed by the Income Tax Act, 1961, and forms a major source of revenue for the government, reflecting the health of the corporate sector. 4. Securities Transaction Tax, STT. Securities Transaction Tax, STT, is a tax on every purchase or sale of securities listed on recognized stock exchanges. Applies to shares, bonds, mutual funds, and derivatives. Levied on the transaction value, not the profit. Introduced in 2004 to curb tax evasion and ensure transparency in capital markets. 5. Alternate Minimum Tax, AMT. AMT is a minimum tax imposed on non-corporate entities like partnership firms, LLPs, and individuals claiming certain deductions or exemptions, to ensure they pay at least a basic amount of tax. It prevents businesses from reducing their taxable income excessively through incentives and ensures fair and consistent tax contribution. AMT is calculated on the adjusted total income, and taxpayers must pay either the regular income tax or AMT, whichever is higher. 6. Dividend Distribution Tax, DDT. Dividend Distribution Tax, DDT, was a tax imposed on dividends paid by domestic companies to shareholders. Companies deducted the tax before distributing dividends, ensuring taxation at the corporate level. Only domestic companies were liable under this law. Abolished from April 1, 2020, shifting the tax liability to shareholders. 7. Wealth Tax. Wealth tax targeted the net wealth or assets of individuals, hubs, or companies. Levied on owned assets rather than income, including property, jewelry, vehicles, and other valuable possessions. Governed by the Wealth Tax Act, 1957. Abolished from April 1, 2016, as the government integrated wealth into the income tax system for better compliance. 8. Minimum Alternate Tax, MAT. Ensures companies with high book profits but low taxable income pay a minimum tax. Calculated on book profits when the regular tax is lower than the prescribed MAT rate. Allows companies to carry forward MAT credit and adjust it in future years. Central Board of Direct Taxes, CBDT. The Central Board of Direct Taxes, CBDT, is a statutory authority in India responsible for administering direct tax laws, including income tax and corporate tax. It operates under the Department of Revenue, Ministry of Finance, and oversees policy formulation, tax collection, and compliance. The CBDT was established on January 1, 1964, under the Central Board of Revenue Act, 1963, following the bifurcation of the original Central Board of Revenue, 1924, into separate boards for direct and indirect taxes. Policy formulation, develops tax policies and recommends amendments to direct tax laws to the government. Tax administration, oversees assessment, collection, and enforcement of all direct taxes in India. Taxpayer facilitation, enhances services for taxpayers through e-filing, grievance redressal, and awareness programs. International coordination, represents India in global tax forums and aligns domestic policies with international standards. Reform implementation, introduces digitalization, faceless assessments, and other reforms to reduce corruption and improve efficiency. Revenue monitoring, tracks direct tax collections to meet government targets and maintain fiscal stability. Impact of direct taxes on the economy. Direct taxes play a vital role in India's economy, influencing revenue generation, economic behavior, and social equity. They not only provide funds for government spending but also encourage formalization, investments, and fair wealth distribution. Revenue generation, direct taxes are a major source of government income, financing infrastructure, education, healthcare, defense, and welfare programs. For instance, net direct tax collections in FY 2024-25 were around 22.26 Indian rupees lakh crore, showing consistent growth. Redistribution of wealth. Progressive direct taxes ensure higher income individuals and profitable companies contribute proportionately more, reducing income inequality and funding social programs for lower income groups. Economic stability. Stable tax collections help the government plan fiscal policy, reduce dependence on borrowing, and maintain macroeconomic stability. Encouragement of savings and investment. Tax exemptions and deductions under income tax encourage individuals to save and invest, stimulating capital formation and economic growth. Formalization of the economy. Compliance with direct tax laws increases the size of the formal economy, as individuals and businesses maintain records and follow legal financial practices. Challenges and limitations of direct taxes. Low tax base. Only around 6 to 7% of India's population pays income tax, which limits revenue despite a large workforce. High tax evasion, underreporting of income, use of cash transactions, and non-filing of returns reduce effective tax collection. Complex tax structure, multiple exemptions, deductions, and frequent amendments make compliance difficult for individuals and small businesses. Administrative burden. Processing assessments, appeals, and refunds places heavy pressure on the income tax department, leading to delays. Litigation overload. A significant portion of direct tax disputes related to assessments, transfer pricing, and refunds remain stuck in tribunals and courts, increasing uncertainty for taxpayers. Impact on investment. Higher marginal tax rates may discourage entrepreneurship and risk-taking, especially for small and medium enterprises. Informal economy dominance. A large share of economic activity still happens outside the formal sector, making it difficult to expand the direct tax net. Reforms in direct taxation. Recent measures. Faceless assessment and appeals, introduced to eliminate human interface, reduce corruption, ensure transparency, and make assessments fully technology-driven. New simplified tax regime. 2020 onwards lower slab rates with reduced exemptions to make income tax filings easier and promote voluntary compliance. Corporate tax rate cut. 2019 major reduction of corporate tax to 22% for existing companies and 15% for new manufacturing units, improving India's global competitiveness. Vivat Se Vishwas scheme. 2020 launched to settle long-pending tax disputes by offering waivers on interest and penalties, reducing litigation burden. Introduction of Annual Information Statement, ACE enhanced reporting system showing all financial transactions in one place, promoting accuracy in income reporting. Tax deducted at source, TDS, and TCS expansions, wider coverage of TDS/TCS to track high-value transactions and curb tax evasion. Improved refund processing, faster and automated refund issuance through the CPC system, reducing delays and improving taxpayer experience. PAN, Aadhaar linking, mandatory linking strengthens identity verification and reduces duplication and fraud.